All right, welcome everyone. Today, we're putting Premium Brands Holding, that's ticker PBH, on the Toronto Stock Exchange right under the microscope. We're going to break down a really thorough analysis from Save Invest Compound to figure out if this company is a hidden gem or maybe one you should steer clear of. So let's just dive right in, shall we? You look at a company like Premium Brands, and it seems like a classic, stable, defensive play. You know, consumer staples, the stuff people buy no matter what the economy is doing. But the real question is, does its stock price actually make sense right now? Okay, so first, let's get a handle on their game plan. Premium Brands is what you'd call a consolidator. They go out and buy up a bunch of well-known household brands. Then they plug them into their massive scale and distribution network to drive efficiencies. It's a pretty straightforward strategy, and honestly, it has led to some really impressive growth. And I mean, just look at these numbers. A 10-year compound annual growth rate of almost 18%. That is fantastic for any company, let alone one in the consumer staples space. They've clearly mastered the art of growing their top-line revenue through acquisitions. But, and this is a big but, as any good investor knows, revenue is just one chapter of the book. Having billions in sales is great, but it doesn't really tell you if the company is actually profitable or if it's sitting on a mountain of debt. And this, my friends, is where our story takes a sharp turn. Because once you start peeling back the layers and looking at the actual financials, well, you start to see some pretty serious cracks in the foundation. First up, profitability. So despite bringing in a whopping $6.4 billion in revenue, their net profit margin is razor thin. We're talking less than 2%. That leaves them with practically zero room for error if costs go up or sales dip. Next, let's talk about the balance sheet. With a debt-to-equity ratio of over 3, the company is heavily leveraged. I mean, it's essentially running on borrowed money, which is a massive risk, especially when interest rates are on the rise. And now we get to the big one, maybe the most important number of all, free cash flow. And it's negative. The company is literally burning more cash than it's bringing in. For any business, that is a huge flashing red light. And this slide just pulls it all together. They're paying their dividend with borrowed money, not cash they've earned. Their return on invested capital is below the level needed to actually create shareholder value. They're totally dependent on acquisitions for growth, and all those acquisitions are diluting existing shareholders. It's not a pretty picture. Okay, so given all these underlying problems, what is a company like Premium Brands actually worth? This is where we have to tune out the market noise and focus on its true, fundamental, intrinsic value. And just to be clear, what we're trying to do here is figure out what the business itself is worth, based on its ability to generate cash, not what people are willing to pay for the stock today. It's all about substance over speculation. Now, this analysis uses a couple of different valuation methods to get a conservative estimate. The discounted cash flow model points to a value of around $62 a share. The modified earnings model comes in even lower at $40. So when you blend them together, you land on an intrinsic value of about $51 per share. And here it is, the big reveal. The stock is trading today for $104, but our analysis of its fundamental worth says it's only worth about $51. That is a massive disconnect. It tells us the stock is significantly overvalued by the market. This quote from the analysis just hits the nail on the head. The market is falling in love with the stable revenue story, but it seems to be completely ignoring the ugly truth about the weak cash flow and the huge pile of debt. So what could happen from here? Where might the stock actually go? Let's run through a few different scenarios to figure out what a rational price to pay for this company would even look like. The analysis models out 3 possibilities. You've got your bear case, where the value is just $38. The base case, which we already talked about, is $51. And then there's the bull case, the most optimistic everything goes right scenario. And even then, the value only gets to $72 a share. That's still way, way below the current market price of $104. So what does that mean for you as an investor? Well, if your goal is to make a solid 9% annual return, this analysis suggests you'd have to buy the stock for roughly half of what it costs today, somewhere in that $45 to $55 range. All right, time to wrap this all up. Let's get to the bottom line. What is the final verdict on Premium Brands Holding? Well, based on this incredibly deep dive, the conclusion from the analysis is crystal clear and pretty blunt. At its current price of $104, the recommendation is to either avoid it completely or, if you happen to own it, to sell it. The big lesson here is that a defensive business model just isn't enough. If the underlying financials are weak, and we're talking thin margins, tons of debt, and negative cash flow, even the most predictable revenue in the world can't save you from a poor investment. Now, that doesn't mean premium brands is a lost cause forever. Things can definitely change, and the analysis gives us a fantastic checklist of what to watch for. We need to see real, sustained, positive free cash flow, debt coming down, better returns, and a dividend that's actually covered by profits. These are the signs of a genuine turnaround. And this whole thing leaves us with a really important final thought. It's a powerful reminder to always look past the headlines and the simple revenue story. It makes you wonder, right? How many other so-called safe and stable companies out there might be hiding the exact same risks just beneath the surface? Thanks so much for joining me on this valuation breakdown of premium brands. I really hope you found it useful. Hey, if there's another company you're curious about and want me to break down like this, just drop the ticker symbol in the comments below. I'd love to hear from you. See you next time.